So, all physicians that you have heard about doctors sheltering multiple six figures of clinical income in taxes, but then they talk about cost segregation, bonus depreciation, and we kind of all feel lost. So, today we will be decoding complex tax strategies with our industry expert, Kim Lochridge. She's a big league tax expert for Fortune 500 and ultra high net worth individuals. So, we'll be diving into how cost segregation and bonus depreciation work, the time value of money and tax savings it can get you, and also tips on how to choose a cost segregation firm. So let's get started and learn how to maximize real estate tax savings.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
Welcome, Kim.
Thank you so much. Well, hi, everyone.
So, introducing our guest speaker, Kim is an executive vice president for Engineered Tax Services. That's an industry-leading provider of specialty tax services in the United States. Kim has an amazing understanding of tax codes as they relate to real estate and energy efficiency incentives, making her a big league tax expert. Kim is personally a real estate investor since the late 90s, and she's on the tax committee for the Washington, D.C. based Real Estate Roundtable Group, where she collaborates with top lawmakers and holds a variety of other board positions. So we are very, very happy and thankful for her time.
Thank you for having me.
All right, so getting started here on some questions. So for our listeners, Kim, who are might not be familiar, can you explain what cost segregation and bonus depreciation mean?
Okay. In layman's terms, cost segregation is an alternative method to depreciating a property. So if you don't do a cost segregation, you have to depreciate on a straight line depreciation. Commercial property is 39 years. Residential property is 27 and a half. Short-term rentals fall under the classification of commercial at 39 years, just for a delineation. By doing a cost segregation study, we actually take that entire building, and instead of depreciating it over 27 and a half or 39 years, we get to extract some of the assets that will not last that long, like carpeting, for instance, or specialty electrical appliances, landscaping, irrigation, driveways, right? Those types of things aren't going to last 27 and a half or 39 years. And so the IRS allows us to put those in different depreciable buckets if you do a cost study. They don't want just anyone doing it. So you've got to have a professional qualified engineer to be able to come out to the property to break down those assets. Not only are we breaking down the assets, but we're also breaking down the cost to those assets and including also a condition factor to each of those assets. And that is what drives the benefit for cost segregation, okay? So the cost segregation is just an alternate method of depreciation, as I mentioned. So instead of depreciating over the straight line depreciation, we're depreciating it under the MACRS methodology. That's the MACRS methodology under accounting. Bonus depreciation is different than cost segregation. I know there's a lot of myths out there, and someone will call and say, hey, I want to get my bonus depreciation. We need to do a cost seg study first in order to get the bonus depreciation on like a purchase, for instance, or a new construction. So bonus depreciation kicks in during certain years at certain amounts. And it's dictated by the IRS, and Congress had put forth those rules for us. And essentially the bonus depreciation, depending on the percentage of each year, will kick in on buckets or assets that are in a bucket that's less than 20 years. So when we shift the carpeting into a 5-year bucket, bonus depreciation applies. If we shift your landscaping into 15 years, bonus depreciation applies if it fits that criteria. So bonus depreciation and cost segregation are two completely different things. And bonus depreciation is a result of usually a cost segregation study.
That's great information. So, Kim, a lot of guests are interested in short-term rental properties, and they were wondering if this applies also to short-term rentals, and how does that go with those kind of properties?
Yeah, short-term rentals are hot right now. Obviously, we have a lot of short-term rentals coming on the market because of the material participation, rules. And short-term rentals, I would say, as long as you have a basis of 200,000 or more, it would be beneficial. We can do them for the smaller properties, but it might be like a different type of study. But we can certainly do the short-term rentals. We here at Engineered Tax Services, we do costing studies on every type of property, anything from a single-family home, multifamily, retail, residential, office, medical office, gas stations, car washes, self-storage, warehouses, distribution, name it. We do it all. So if you own investment, property or income producing property, a cost segregation is usually a very good option.
Yeah, that's good to know that you serve a variety of property types. A lot of our physicians have their own practices and they own a multiple business, and then now they're getting into real estate. So it could be an avenue for multiple ways to do this.
Yeah.
So
And
excellent.
we talked about the short-term rentals being a great option because it does help offset the W-2. But if any of your doctors actually own their own medical office space and then rent that back to themselves as a self-rental, they can actually also usually qualify for offsetting their W-2 wages. That could be active income for them because they're housed in that office building. So don't forget the medical office spaces, or let's say you lease a space, but then you put in maybe $200,000 or $300,000 or $500,000 worth of improvements or tenant improvements in that. We can do a cost seg study on those improvements as well. So there's so many ways to utilize a cost segregation study.
So, Kim, walk us through what a typical cost segregation study process looks like, starting from calling you and getting you on board, and then what does it look like in the process?
Yeah, so the process takes about 6 weeks from start to finish. But once I get the information, usually just a settlement statement or an appraisal, I can usually do a benefit analysis and a fee structure for each individual. Usually those turn around in 24 to 48 hours, so we can get those out pretty quick. That way you can have an idea of what you think the benefits or what we think the benefits are going to be, as well as the cost to do the study. Once we get the signed contract, we do require 50% down, and then we get going on it. About 6 weeks later, we will deliver the final report. In that time period, we will be doing a site visit by our engineers. That site visit usually happens in the first week or 10 days after they sign the contract. And once that site visit is done, then it just takes our engineers to rebuild that building.
And so, Kim, what is a good timing to get a cost segregation study? Most of our clients are getting into properties, they're looking at deals and maybe closing here soon. Some of them have closed. So should we get on this right away, or should we wait till, tax time? How do you think that would be a best time to do this?
Yeah, it's a great question. If I had a magic wand, I would suggest that everyone does it as soon after close as possible. The reason for that is because once you close on a property, there could be renovations or modifications that you do to that property in order to get it up to speed or running or making some repairs or improvements or maybe just expansions, things like that. When we do our cost seg study, we are establishing a baseline to prove to the IRS what was there at the time of purchase. So if we can get in that property before you make any adjustments, improvements, renovations, or any construction differences, that's always best. Now we can always go back and recreate and try and put together what was there before that if you've already done improvements. So it doesn't prevent us from doing it. But if I had a magic wand, it would be easier for all of us if we can get into that property as soon after purchase as possible. Again, so that we're setting that baseline for the IRS and proving what was there. Any major improvements over $50,000, we can also do kind of an add-on study, and that one will essentially break out all of the different buckets for the improvements as well. As mentioned, that's like a threshold of about 50,000.
So you're basically segregating what was already there at the property. So let's say I go in and do improvements. Let's say I put in make a new fence, I put in a hot tub, things like that. So those will be excluded from the cost segregation study?
From the original purchase study, yes. And then they would be layered on top. So essentially we set the baseline by doing the study on the existing building, what was there at the time of purchase, and then all of those other things get layered on top.
And also for people get into short-term rentals in their first year, and then in the second year, they are turning it into passive income. So talk about maybe using syndications as passive losses to then offset the passive income in year 2 or year 3 when the rentals are earning passive income at that point. Have you had clients who are using that strategy?
Yeah, I do. So getting the short-term rental up and running is, a huge benefit. If you're following the material participation rules, you're taking, you're calculating your hours and you're tracking all of that, and you're actively managing that property, then with the material participation rules, the deductions from the cost seg study offset your W-2 or ordinary income for the household. That's always a great time to do it. Like right now, we have 60% bonus depreciation, so you get 60% of that upfront. All right. So obviously, it was better when we had 100, but hey, 60 isn't bad. So we take the 60%, not of the total purchase price. It's 60% of the assets that we put into the 5 at 15 property. Okay. So I don't want to mislead anybody. But that typically works very well. And then if you say, for instance, either don't meet that material participation in year 2, or if you decide to change that into convert it into a long-term rental the following year, then essentially it just converts. You have to qualify for the material participation every year. If you don't qualify for that material participation in 1 year, then essentially it just offsets your passive income. So that means the income from that long-term rental will be passive, and then the deductions will offset that income, but it will not offset the W-2. For a visual, explanation, I find it, if you have ordinary income, like from your W-2, you can offset things like, you can offset that with things like your primary property tax or your mortgage interest, right? You can do those things. And if you end up, that's ordinary activity, right? Now, if you have investment property, that would be long-term rental, would be on the passive side. It's a separate bucket, right? So you have 2 buckets. You have your ordinary bucket and your passive bucket. And if you think there's an imaginary line between the two, you cannot cross that line. Okay. So there's these 2 different buckets. What's passive activity stays here. It can just offset what happens here. This side is your ordinary and only offset what happens here. When you have material participation or a short-term rental, that line disappears, everything gets melded together. That's why the depreciation offsets W-2 income. But on a long-term rental, it remains passive, and you put that line back, delineating the 2 buckets. So once you have to go back to non-material participation, or you turn it into a long-term rental, you've got the majority of the benefits up front anyways on that one. So turn it into a long-term rental, save yourself a little bit of time, get a long-term lease in there or whatnot, and then start a new Airbnb. And then you can take the material participation from the new one, and then the next year, turn that into a long-term rental. So it's actually a really great process to be able to do something like that. And still be able to offset the majority of, or use that depreciation to offset your income.
And that is true for syndications, right? I know Param's group has the gwcapital.com where they have investment opportunities for syndication.
Hey guys, I am super excited to present our next opportunity. After months of due diligence, we have a new deal in the Austin, San Antonio hypergrowth corridor. And the best part is that every GW investor gets reserve class preferred returns in this deal. The Villas at Sundance is a 252-unit Class A Core Plus asset built in 2012 in New Braunfels, which is the third fastest growing city in the country, with a population growth of nearly 33% in 2023 alone, with many new major employers, entertainment, and the economic impact from tourism in the area is about $700 million. This is the submarket where I've been underwriting deals for the last few years for my personal portfolio. It has the highest occupancy in the Austin-San Antonio MSA, and since this is a Core Plus asset, it has high cash flow day one. The debt terms are conservative. That, coupled with the expected population growth, makes this a lower risk opportunity for the current economic cycle. And to make things sweeter, we're acquiring it at a substantial discount compared to the cost to build new in the market. And again, all GW investors get reserve class returns on this deal, which is huge. So if you want to learn more and catch the investor webinar, go on to generationalwealthmd.com/Austin in lowercase.
So you could take the bonus depreciation from the syndication as passive losses and then offset the passive income that now your short-term rental is making in year two, which is the passive
Correct.
income.
Which would be the long-term rental. Yes.
Yes.
That's right.
So that's
a little bit more complicated. When you have multiple activities in your passive bucket, say you have the syndication and then you have a couple long-term rentals, your income, your losses can offset the income on the passive side, but you need to group them together. So your CPA would have to group those activities together in order for them to offset. Otherwise, they stay independent for each passive deal. Okay, so there would be a grouping election that needs to happen.
That's good to know. That's excellent. And so are there any, upcoming changes? We mentioned, 60% bonus depreciation this year, and we are hearing rumors about, 100% bonus depreciation coming back. Do you have any inside, information there on what's going to happen in the next few years?
Yes, and thanks for asking, because there's a lot of misconception about that. Everyone thinks the 100% did come back because it passed the House. It did not pass the Senate. So we got through halfway. I will give you some kind of inside information as to why this is so tricky, so you're all educated about it, because I think this is very important. So we have, two sides of our government, right? So in the bill that the bonus depreciation is housed in is also housed with the child tax credit, as well as amortization for the research and development tax credits. So they're bundled together, among other things, but those are the biggest ones that impact me personally. So those are the biggest ones. The bonus depreciation is kind of a no-brainer. It's just a reallocation of depreciation. It's not any more or less money in the pocket of the IRS. It's essentially just spread out over a different time. Same thing with the amortization of the R&D. The problem is the child tax credit is very controversial. So because they packaged it with the child tax credit, that's what's holding the whole thing up. That's why it passed the House, but it did not pass the Senate. The senators, what's happening in the child tax credit, I think this is important to shed light as to what's really going on out there. In this American Family and Workers Act that the bill was proposed, the child tax credit is one, they're saying that they want to give the child tax credit based on 2 years ago salary, which was essentially COVID. And so what they're trying to do is use salary from 2 years ago to give you a credit today, which Republicans are saying we think that's inflated. So the other thing that they're trying to do is they're trying to give the child tax credit to anyone who has a TIN, a taxpayer identification number. You do not have to be a citizen of the U.S. to have a TIN number. So what they did was they opened up all the borders. They're bringing in a lot of illegal aliens, allowing them to cross the border. They're giving them TIN numbers, and now they're trying to get the child tax credit to people who aren't even citizens of the United States. That in itself could be a controversial topic. The Republicans are trying to stop that. But I think the biggest issue politically is that it's a very slippery slope, because once you allow someone with a TIN number to get a tax credit or cash in their pocket, because it's a refundable tax credit, then they could propose that, hey, now we're going to let people with a TIN vote. So now you have the problem with, yes, we've opened up all the borders. We have a bunch of illegal aliens here. We're giving them money through a taxpayer identification number, and now we're going to allow them to vote even though they're not citizens legally. So as you can imagine, the Republicans are up in arms about the child tax credit. It's a huge issue and very controversial. And this is what's stopping our bill, right, for the bonus depreciation. So the child tax credit is much bigger than the bonus depreciation. So in this sense, what we're hearing from the senators is that they're just going to pause on this particular bill. They'll either repackage this, away from the child tax credit, or they're simply going to wait until after the election to decide who takes control of the House and then decide to put together another tax bill that's more robust. That's just, has to do with those things and uncoupling it from the child tax credit. So that's really what's going on behind the scenes. That's why we have this, did it pass, did it not pass? That's the God honest truth. So everyone can take it. You've heard it here. And hopefully that helps fill in some blanks as to why this has stalled.
Wow. That's great information. So for now, we'll just stick to the 60% for 2024.
Yeah,
and then
for now.
Over 40% next year. So that's nothing changes, right?
Yeah. But let me just make sure that everyone understands this part of it too. Let's say you get 60% bonus depreciation. The bonus depreciation applies to the 5 and 15-year property, remember? That means you get 60% of it up front. The other 40% is still delineated over the 5 and 15-year buckets. You're not losing it.
Right.
You're going to get it, and you're going to get it faster than your 39 years or 27 and a half years. You just don't get it all in year one. But what's really interesting to remember is that most people, if you're doing a short-term rental and you have a high income, then yes, you can use the deductions. But if you're in a passive situation, you can't use all the deductions. It just rolls over to the subsequent year. So you can use it multiple years. So it's not as bad as it sounds. It's not like you're missing the other 40%. You're going to get it, and you're going to get it in shorter buckets. You just don't get it in year one. So it's kind of nice for some people who are high income because it actually feathers the depreciation across 5 years. And so that you're taking little chunks off of every year's salary instead of just one big year, and then you have to deal with the tax burden the following year. So it could actually be a really nice tax strategy tool by just taking the 60% and then shifting it over for the rest of the 40. So I just wanted to leave that because I think it's an important topic.
That's a great perspective. So like you said, you're still will get the 100%. It's just, when you get it. Yeah. Exactly. That's great. So that brings me to the topic of, what happens when you sell the property. So that's very confusing for everyone. What does depreciation recapture? And then do we have to give all of that when you're at that point of selling?
Yeah, another great question. I really appreciate it. So when you do a cost study, imagine a portion of the building again goes into 5-year bucket, 15-year bucket, and the remainder goes into other 27 and a half or 39-year bucket. Okay, so you have all these buckets to deal with. So let's say you did a cost study and you have a 5-year bucket and you sell it in year 3. Okay, so recapture is kind of like prorated, right? So you've already taken the 3 years, you pay back the 2, right? So. But what ultimately happens in recapture is that you pay back what depreciation you have not taken, that you took up front, but you didn't have it all. So it's kind of like getting an advance on a paycheck. Let's say you start a job and you go to your boss and you say, pay me 5 years up front. Okay, here's a check. And then you quit your job in year 3 when he paid you 5 years. You don't get to keep it, right? You have to give back the 2 years, but you worked for 3, right? So there's that. But also there is a way to get around the recapture, and that's if you do a 1031 exchange, then essentially you don't have to pay that back. You basically just roll that over into the new project. So you still get to keep the benefits. So I always recommend that, if you buy a property, do a costing study, and then you have an offer you can't refuse. They weren't really planning to sell it, but you have this great offer in year 2 or year 3. Certainly do it. Run the numbers both ways because there's multiple ways that you can get out from underneath paying that recapture, but a 1031 is the easiest. But run it both ways because there might be some other options that you could do there, especially if you're going to be buying another property. So just so you know, the recapture, yes, is there if that's all you're doing. But you want to incorporate some of the other tools and incentives out there so that you don't have to pay that.
So yes, so 1031 is basically rolling over into a bigger property and into another investment property. So that you can avoid the recapture at that point. So we can introduce you guys to 1031 exchange providers as well if anybody's looking for that. A lot of people have asked, do I have to do the in-person engineered cost segregation, which we all recommend, but then we see people, doing some cost savings with DIY studies. And could you tell us, why that's not what we need to do?
The IRS has a guide. It's called the Audit Technique Guideline for Cost Segregation. So the IRS wrote a guideline for the IRS auditors to follow when and if they come across somebody who has a cost segregation study in that return. So basically, in that audit technique guideline, we get our regulations, we get what they're looking for, we know what their intent is, what they want. And it is very, very clear that they do require an in-person site visit. They mentioned that probably 15 times in the audit technique guideline. In addition, at our last cost segregation conference we had speakers from the Department of Treasury come talk to us, auditors essentially, and telling us that if we do see a cost seg study and it was not visited, or if it was a virtual study, we will just throw it out. It will not be accepted. So it's very clear in the audit technique guidelines that what their intent is and what they're specifically looking for. The virtual site visits were approved and allowed short-term for COVID because we couldn't travel. We weren't supposed to be in close proximity, so it's normal that we could still do those. But we would have to do it virtually. That has since been turned off. The IRS has been very clear about that was only during COVID. And the only way that you can get out of not doing a site visit is if you had COVID. So now we're kind of outside of that. The other thing is that I see some of our competitors are doing, they hire somebody like a photographer to go take some pictures. Anyone can take pictures, right? The IRS wants to see that it's a qualified building professional, and somebody who is a photographer is not that. One reason for that is when we do our studies, we are doing a condition factor. We look at the age that's left of each asset. So when you go in with somebody who's not a building professional, are they really going to know how old that HVAC system is? Are they really going to know how old or how many years are left on that roof? That's not something you can just take pictures of and bring that back. So you need to have somebody who is really knowledgeable of what they're doing, and do it right. Yes, it might save you $1,000 to go with a DIY or something like that, but what is the risk if you get audited? I will tell you also, and not to scare you, but everyone knows that the government had approved for the IRS to hire 87,000 new agents. They're putting those towards audits. So we've seen a huge uptick in audits lately, and that's something that is just the nature of the beast. So they are looking for these. Now they have the manpower to do so, and I think it's important that you get what you pay for. Make sure that you're doing it right. You have a qualified professional. Our company's been doing this for 23 years. We have a fantastic track record, and we have a great relationship with the Department of Treasury. That's who I would be looking for, that longevity, and make sure that you're getting a legitimate study.
So, we're ending the talk here. Any final advice you would give to our physicians who are getting into real estate? Any top tips from the expert?
I would just make sure that when you're doing deals, when you're doing your due diligence, make sure that you're using a worst case scenario, especially in short-term rentals. Short-term rentals are growing leaps and bounds. And if you know anything about economics, it's a simple supply and demand. We have a lot of short-term rentals coming on the market, okay? Let me give you some statistics. Our company runs between 400 and 600 studies a month across the country, in every state across the country. 47% of those are single family homes. Right? This is a huge change for us over, say, 3-4 years ago. I would say the majority of those are short-term rentals. When you have that many short-term rentals coming on the market, there's bound to be some supply issues, right? Supply and demand excess. So that's going to drive the costs down to what you can rent those properties for. And I think anyone who's done short-term rentals, I've done them since 2011. And anyone who's been in that space knows that there's definitely the last couple of years been an impact on the income for short-term rentals. So run your numbers on the worst case scenario. Do not rely solely on the income from that property with assumptions. It's going to be really hard to know exactly what that income or what that property is going to draw. So just make it a worst case scenario. Okay. And then everything up there will be gravy. So that's my biggest piece of advice. Run the numbers, be realistic with those numbers. What you don't want to have happen is you get into a situation where it's not going to cash flow and you can't afford it. So that would be my biggest caution.
Yeah, that's what I say, because this is hard-earned money that we have worked very, very hard for, that you're putting into an investment. So it better be cash flowing. Otherwise, there is really no point chasing the tax advantage if it's really not cash flowing.
That's right. That's right.
So thank you so much again, Kim. Thanks for joining us. And this was so insightful. I learned so much from you today. And so thank you so much, Kim.
No problem. Anytime.